the slowdown that you're expecting, you were thinking that growth would be 3.3% 2024. That was the number that the market was looking at. But for this year, we're now sliding back to the 2.9% level. How concerning is that slowdown in growth, and where do you think the real drivers are because of this tariff war in terms of causing a slowdown?
Well, good morning, Ed. The reasons why we downgraded almost everybody in our forecast is that trade uncertainty and economic policy uncertainty has reached unprecedented levels in the past few decades. As a consequence, we've been seeing that consumption and investment has come down. And in fact, activity indicators also have come down. And if you take this into account and you also try to estimate in our models, you see that there'll be less growth, less jobs, and more inflationary pressures going forward.
Typically, when you get a growth slowdown, that is accompanied by a slowdown in inflation. But this time, and again on the back of those COVID trends, when supply chains are disrupted, you see that often there can be stickiness in the inflation. In your report today, you're talking about stubbornly sticky goods price inflation related to food, but also around services still. In Europe, at least, we saw services start to wobble in some of the recent PMI numbers. Does that give you any hope that services could actually be moving a little bit lower when it comes to inflation?
Well, we still see stickiness in service price inflation, not only in Europe but other parts of the world. We also see that goods price inflation has ticked up a little bit. And in fact, because of all the trade uncertainty and tariffs, we also expect that inflation in the United States will reach about 4% at the end of this year before it comes down next year. And so this complicates the matter for monetary policy because obviously you're leading with less growth and more inflation. And it becomes a lot more complicated for policymakers.
Alvaro, it's a fascinating report. Is this all, let me just cut to the chase. Is this all about the global trade uncertainty inaugurated by the new administration, or is it about longer lasting problems, including the fact that the Chinese can't get their consumers to spend money and they're still saving at a rate of knots?
Well, we do think that in order to solve the current account imbalances, we need to have fiscal consolidation in the United States. And on the other hand, we do need to have pension reform in China so that consumers or households don't have to save for a rainy day and for their retirement because the state is not providing. So to reduce durably the trade imbalances, you do need to have this happening. But on the other hand, we also think that one of the things that we don't highlight too much in this part of the outlook, but we do it when we look at investment, we do think that there's a widening gap in terms of productivity between the United States and the rest of the world. And this is because of AI and because of the diffusion of digital technologies. Productivity has been very strong in the United States, and we expect that likely this will widen the gap between the United States and the rest of the world, exactly because the exposure to AI by sectors in the US are higher. The adoption of AI has been higher, and as a consequence, we also expect that productivity growth in the United States will be stronger in the medium to long term than in other countries of the world.
So let's get to the next point then, I guess, in my view. If we can solve the trans-Pacific trade issue between China and the United States, other issues are perhaps less prevalent in terms of the imbalance of trade. If we can solve that, given the fact that we're going to potentially get lower rates, given the fact that we're going to get reorganisation and deregulation in economies globally, and we're seeing more spending in countries such as Germany, United Kingdom, elsewhere, actually we could be on the cusp of quite a golden period potentially if we can sort out the China-US trade issue.
I think if we are able to get trade agreements between countries, not only between China and the United States, but also other parts of the world, and if we are able to reduce uncertainty, we do believe that we might be on the cusp of something quite significant. It's AI is also quantum computing around the corner. Also, robotics is adding to the equation. So we see that the possibilities of having significant productivity revival is here, but we need to make sure that in the other areas we are also bring lower trade barriers and so on, so that we have more investment and more consumption. So both areas have to work together so that we don't have an area that works very well, but others are not doing so well.
Well, Alvaro, Europe is very much determined to not be left behind in this latest technology wave, and as poured resources into the economy, and that is around defence, infrastructure, but some of this really does touch the sides too in technology. Is there any sense that Europe will also enjoy some of the productivity gains from AI, quantum robotics?
Well, certainly Europe will benefit from part of the spillovers. But right now, Europe is nowhere to be seen in terms of the impacts of AI and the diffusion of AI. So you have some firms that are working on this, but basically we don't have, in terms of patents, in terms of innovation, in terms of investment in AI, the United States is, miles ahead of the European economy. So we look at this in terms of R&D, we look at this in terms of software and data, we look at this in terms of patents. And Europe is, quite behind. And so Europe needs to get its act together, address huge skill shortages that continue to plague the European economy. At the same time, invest more decisively in these new technologies that will bring a lot more productivity.
Alvaro, a strong message for the Europeans. I want to come back to the message that you made around the US needing some fiscal consolidation, because effectively the 3.3 trillion is what we're seeing added to debt by 2035, according to the big beautiful bill that Trump has come up with. Bipartisan think tank has been crunching the numbers on that bill and the implications. What sort of an approach do we need to see from the US in terms of tackling its fiscal position? Because already we've got Jamie Dimon from JP Morgan saying, look, there's a crack in the bond market.
Well, we have been concerned about the fiscal situation in the United States for a while. Debt in the United States is fairly high. And we do incorporate the new bill into our forecasts. And of course, will help on the growth front. But that will entail about a deficit of about 8%. So more needs to be done in terms of fiscal consolidation, in particular efficiency in terms of expenditures, and be able to potentially raise more revenue by broadening the base of some taxes, so that you have more revenues and less expenditures. So, but the most important thing for the United States, of course, growth can help, but the most important thing for the United States is fiscal discipline is absolutely key to avoid trouble down the line.
Alvaro, is fiscal discipline in the States, are they the only ones who've got this problem? Because it seems to me, when I look at the IIF figures from Tim Adams's group on a regular basis, it seems to be the emerging market debt growth that actually is the most precipitous, and we're seeing the most incline there in debt profiles. Is it the US or is it elsewhere we need to worry about more?
Well, we need to worry about a lot of countries. So OECD countries, just to give you an idea, debt has increased by 40 percentage points in the last 25 years. And has been a big increase. We are at unprecedented peacetime levels of debt, and we have spending pressures that are pressing for defense, for the green transition, for aging. And so these will add to the pressures in OECD countries. For developing countries, one big challenge we'll have in the next 2 years will be refinancing their debt, especially for low-income countries. We have 40% of this debt is in highly speculative category. And so we expect that some countries might have trouble refinancing their debts.